Guys, really excited to share this amazing practical video on ESOP. So what are we exactly going to cover in this amazing video? We will start with what is the reality versus myth for ESOPs. Thereafter, we will move to the exact life cycle of how the ESOP works through, including the different routes by which we can issue ESOP. Thereafter, we will check on the compliances. So basically, what are the PIT compliances with respect to ESOP? What are the FEMA compliances with respect to ESOP? As well as understand it from the tax perspective. Also, we will go through all the four stages of ESOP, that is grant, vesting, exercise, as well as sale. So let's get started. Now, you might have heard in the papers that a lot of time it's said that the company has granted stock options or ESOPs to its high performing employees. So if you ask a non CS person, what does that news mean? He will simply say to you this: the company has given them shares. But this is a big myth. The reality is not the same. The reality is, as a CS, we need to understand that an employee stock option just gives the employee a right and not an obligation to buy the shares at a predetermined price at a future date. So now let's understand the life cycle of ESOP. Now, this person is Mr. Elon and he's an amazing employee for the company. Now the company, as it wants to retain him since he's such an amazing employee, it will grant him ESOPs. Now this person, Mr. Elon, has to wait for a certain period of time. Once that period is done, thereafter, he will say to the company, I want the shares and have to pay some money, which is he's buying the shares, right? As we remember in our earlier definition of ESOP, and thereafter the company will give him the shares of the company. But as a CS, you may say, why should I learn ESOP? Also, just one important thing is there might be few RBI compliances filings that the company needs to be made in case if Mr. Elon is a foreign national or a NRI. Here's the first case. As you can check in, the ESOPs are worth 1,800 crores for Paytm's founder. Second case. Here, the ESOPs that were given, which were unvested, is 1,000 crores. You can imagine the worth of ESOPs that is there in the market. And as a CS, you can't miss on these things. So now, let's again get back to our example of Mr. Elon. But before moving forward, one important thing is that we need to be aware of the terms of ESOPs. Since without, as a CS, we are corporate professionals, right? So we need to use professional terminologies for this. So this person, Mr. Elon, in terms of your ESOP, is known as option grantee. This waiting period is known as vesting period. The time from when the Mr. Elon says, I want to buy the shares of the company, from your vesting period till this time is known as exercise period. This money that he needs to pay is your exercise money and tax money, that is your on purchase tax. So now once we know the terminologies of ESOP, let's get started on all the four stages of ESOP. The first is grant stage. The second is your vesting stage. The third is your exercise and allotment. And the fourth is your sale. Now, stage one, the grant. This is where Companies Act and SEBI compliances trigger in. Under Section 62, subsection 1, clause B of Companies Act 2013, we need to pass a special resolution in a general meeting. The moment there's a general meeting, few compliances that directly click in any CS mind is notice to shareholders. With an explanatory statement, there are few specific items that need to be covered when you're going to your shareholders for ESOP schemes approval. Also, once it's approved, you need to have your Reg 44 filings as well as Reg 36. This will need to be made in filing of MDT 14 within 30 days, and your scheme needs to be approved. That's the most important thing by shareholders. Now, a quick question that comes in her mind is how will the company issue the shares? So, as a CS, this is the most important thing that you will be concerned with, right? So, the answer is given in SEBI SBB regulations. The full form is Share Based Employee Benefits and Sweat Equity Regulations 2021. The first is the direct route, and the second route that it gives you an option with is your trust route. Now, what do we exactly mean by direct route? Let's see it with an example. Another company would grant the options to an employee, and the employee will thereafter exercise his options, basis which the company will provide the shares to the employee and would have taken the exercise money from the employee. This is a very simple direct route method, no much things to think about. The second is the indirect route. In indirect route, there are two methods. So I'll start with the first method, which is known as which I call as primary route indirect method. In this route, the company will provide a loan to the trust. The company would have created a trust to allow the shares to the employees. So first, the company will provide a loan to the trust, which will be managed by the company. The trust will use this money to obtain shares from the company. So the company will allow the shares to the trust, and once it receives excise money from the employee, thereafter it will transfer the shares through off-market transactions to the employee. So this is the indirect primary route for issuing ESOPs to the employees. Now, the second indirect route method. Here, in the similar basis, company will first give loan to the trust, basis that the trust will purchase the shares of the company from the market. That means NSE or BSE. So once the company shares are with the trust, as and when the employees are exercising their options and it starts receiving the exercise money, it will start transferring the shares to the employees on off market basis or on market as the case may be. So this is the second method. Now what are the pros and cons for both the routes? Because as a CS, this is important this thing that you need differentiates a CS from the rest of the professionals, that we are aware of the practical insights of each and every scheme, like how what would be the pros and cons of them. So let's go first with the direct route. In the direct route, and second is the trust route. In the direct route, it is very simple. The process, it's very simple and straightforward. There are no much compliances that trigger in. Employee becomes a shareholder immediately, lower administrative burden. Cons is, since every time fresh issuance is made, it is diluting your existing shareholding. Companies to bear the cost. In terms of your indirect route, that is trust route, the company can buy back its existing shares from the market and transfer those shares to the employee. This leads to less dilution of the shareholding of existing shareholders, and it also provides a more flexibility on cashless exercise. So one of the important types of exercise that is can be availed through your trust route is cashless exercise. So what is this exercise? In this exercise, for example, I'm an employee and I have exercised my 100 options, which with each option translating to one share, as I said by company. Now I am eligible to get 100 shares, but on that 100 shares, for example, I will also have to pay my exercise money as well as my tax money, right? So what do I tell the company is you sell certain portion of my shares in the secondary market equivalent to my exercise money plus tax money, and rest shares you give it back to me. This is possible only in your trust route method and not direct route. But the cons for this is first is you need to now have your trust and fulfill all its compliance obligations. You need to maintain separate book of accounts for each scheme. It's more complex administration because now you have to manage your trustees as well as trust compliances as well as your loan repayments, which would also translate into your RPT transaction between the company and trust. So it's lots of administration compliances that trigger in. That is the con. Now, few quick doubts that might come in. Can you switch the routes? So SBB regulation says yes, but you need to have a fresh shareholder approval. A second question, which is your bonus ones. Yeah. Can I run multiple ESOP schemes through single trust? The answer is yes. But you will need to maintain separate book of accounts. There will be no mixing and matching between schemes. Every single scheme is separate and needs to be treated separate. There will be no fungibility without shareholder approval. Now, a manager remuneration query, which might click to you as a CS, is this. If we give ESOPs to our directors, does it count as managerial remuneration? The answer is yes. Why? Under Section 197 and 198, if you would have read, ESOPs are treated as perquisites and thus included in the managerial remuneration limits. But why does it matter? The reason is very simple. Yes. A company with inadequate profits can pay manager remuneration only, as we remember, up to a certain limit. So if you're giving ESOPs which breaches this limits, you are in violation of Companies Act. Hence, this needs to be taken care of. Now we're done with the stage one, which is your grant stage. Now let's move ahead and go to your vestings. Vesting is simply when the employee becomes eligible to exercise. Here no shares are issued, so no tax obligations, but you need to maintain a vesting register, grant letters, ESOP ledger, because auditors will check the same. Stage 3, exercise. This is where employees panic. Under Income Tax Act 1961, perquisite equals to FMV on exercise date minus exercise price. Example. Let's see. For example, if my exercise price is 100, my FMV, fair market value, is 500 of my shares. So my perquisite would be 400 into 100, and which is 400 per share. On 1000 shares, it would be 4 lakhs, which would be added to my salary. A 30% slab become translates to 1,20,000 in tax, which needs to be made upfront before shares are even transferred. Few compliances as at a glance during time of exercise from Companies Act and SEBI compliances. First, you would need to convey your board or NRC meeting as the case may be. In case of board, then 2 prior days intimation needs to be given under Regulation 29. You need to approve the allotment. Once approved, I would advise within 30 days, inform or 30 minutes, inform the stock exchanges, apply for listing cum trading approval, file MGT 14 and pass 3. Also, in case you've already obtained your listing cum trading approval, then no need to obtain trading approval separately. Just listing approval would be enough. If there is no lock-in applicable for ESOPs, employees who exercise their ESOPs are free to trade their shares in market. Stage 4, sale. In terms of your stage 4, which is the sale, I'll divide in two important parts. One is a tax and one is a PIT. So as you know, while selling your shares, you will attract capital gains tax, which will be sale price minus FMV on exercise date within 12 months, short term and post 12 months, long term. The next question. Can you grant ESOPs to your foreign employees in UK, US, or Singapore? So what do you think? For example, your employees are sitting in New York and your managing director comes and asks you this question. What would your answer be? Okay, so the answer is gonna be yes. Welcome to FEMA Compliances. As a CS, remember a key principle. Investment from foreign employees is treated as FDI. However, we have a neighboring country problem. That means that as a CS, you need to remember this one rule. If your employees are based in China, including Hong Kong, Pakistan, Bangladesh, Nepal, Myanmar, Afghanistan, these employees are falling in the restricted jurisdiction and you would need RPI approvals, no exceptions, before even you can grant ESOPs to them. So never structure your ESOPs first and check FEMA compliances later. A pro tip from a CS colleague. Also, few checklist things before you grant your ESOPs to foreign employees. Check their employee jurisdiction, check sectoral caps, check approval requirements that you're clear with your FEMA compliances. And from talking about FEMA compliances, the thing that reminds me is because this is the place where most people mess up. Okay, so at the time of grant, you need to file Form ESOP within 30 days from the date of grant, which is filed to RBI Forms portal. At the time of allotment or exercise, you need to file Form FCGPR within 30 days of date of allotment, which would be covering your exercise valuation, FDI reporting. If you're using trust route, in that case, you need to file Form FCTRS within 60 days of date of transfer or remittance, whichever is earlier. This would be applicable when the company is using trust route, so the trust has acquired the shares from whether shareholders or through allotments by company and thereafter has transferred these shares to the employees. Only then you will file from FCTRS. Compliances, because this is the second most important place in your ESOP. So one of the important questions that comes to us as a CS is whether do I need a preclearance for exercising options? Was so the answer is a clear no. Exercise of options is covered in the clause 4 subclause T subclause B of schedule P of PIT regulations. So no preclearance required. But and a big but, sale of shares after exercise, in that case preclearance required. Let's assume Mr. Elon, whom we had given shares, when it's exercising ESOPs, does it need preclearance? No. But at the time of sale, yes. Thereafter, as we talked about cashless exercise of ESOP, in that case, the answer is yes. PIT regulations define trade to include both on market and off market transactions. So, in terms of exercising cashless, you need to get a preclearance. The reason being very simple is you're selling shares on behalf of an employee. Hence, that's the logic why preclearance requires during ESOP, cashless exercise. The next thing is, can you grant ESOPs during trading window closure? The answer is yes. Because grant of ESOP is not trading, it is giving a right and not executing a transaction. However, in terms of exercising of ESOPs, you need to follow company specific code of conduct. Why? The reason being is very simple. During your trading window closure, the demat accounts of your employees are pan freeze. Hence, even if you do an off-market transaction of the company will grant you shares, your demat accounts will be frozen for that particular ISIN or the security. Next, contra trade. So, what is the contra trade rule? Designated persons can't do opposite trades within 6 months in the open market. But then exemption, ESOP is exempted. So ESOP is not included in this contra trade transaction. What about multiple ESOPs? No, they still don't attract contra trade. So here's the PIT cheat sheet. Exercising ESOP not equal to trade. Sale after exercise is trading. For designated persons, no opposite trades within 6 months. ESOP exercises are excluded from this. Trading window matters because you cannot sell when the window is closed, cannot sell with UPSI. There's a wonderful surprise for you guys. I'm soon going to be sharing an ESOP checklist. The link for getting the same is below, or you can scan the QR code which is appearing on the screen. Also, if you have any doubts, you can contact me via my website's email page here. Join the newsletter where I share amazing articles on SEBI's latest amendments as well as your MCA, that's Companies Act amendments, FEMA compliances, and all amazing things. So thank you for staying with me and all the very best.